The decision. Most Americans never heard about. While headlines focused on inflation prints and stock market swings, a far more consequential decision quietly crossed the finish line in Basel, Switzerland. The Bank for International Settlements, the BIS, often called the Central Bank of Central Banks, has now moved Basel III's so-called endgame from theory into finalized global guidance. This is not a market rumor and not a social media theory. It's the last phase of a regulatory framework that has been more than a decade in the making, and national regulators are now locking in how it will be enforced. Here's why that matters. Basel III Endgame sharply raises how much real loss-absorbing capital large banks must hold against their assets. According to BIS impact studies and regulator estimates cited by Bloomberg and Reuters, capital requirements for the biggest U.S. and European banks rise roughly 15% to 20% compared with the old rules. That may sound technical, but it has a very real translation. Banks must either shrink risk or shrink lending. This comes at the worst possible time for the average American household. Credit card balances just crossed $1.13 trillion. That is the highest level ever recorded, according to Federal Reserve data. Auto loan delinquencies are at their highest level since 2010. Mortgage affordability is already crushed, with monthly payments on a median-priced home up more than 65% since 2020 due to rates alone. Basel III Endgame doesn't cause these problems. It locks them in. Banks don't create capital out of thin air. To meet tougher rules, they reduce balance sheet exposure. That means fewer business loans, tighter credit standards, and less flexibility for households already living paycheck to paycheck. This is why JP Morgan, Goldman Sachs, and Bank of America have all warned publicly, in earnings calls covered by CNBC and the Financial Times, that higher capital requirements directly reduce lending capacity. And here's the part most people miss. This isn't about preventing the last crisis. It's about preparing for the next one. Regulators are signaling, without saying it out loud, that the global financial system is entering a period of higher risk, higher volatility, and lower margin for error. When the rule book tightens this late in the cycle, it's not a sign of confidence, it's a sign of concern. Why regulators push this through? Now, here's the question you should be asking. Why finalize stricter banking rules when the economy is already slowing? Regulators don't move this late in the cycle unless they believe the risk of doing nothing is worse than the damage the rules will cause. Start with the balance sheets. Since 2020, U.S. federal debt has exploded past $34 trillion, growing at roughly $1 trillion every 100 days. According to the Treasury and Fed data, interest expense alone is now running above $1 trillion annually, more than the entire defense budget. That matters because banks are heavily exposed to government debt, which regulators still label as safe, even though rising rates have crushed bond values. We already saw what happens when that risk is ignored. In 2023, Silicon Valley Bank collapsed after unrealized losses on Treasury and agency bonds wiped out confidence. Those losses didn't disappear. They were papered over. As of the most recent Federal Reserve data, U.S. banks are still sitting on over $500 billion in unrealized losses on securities. Basel III Endgame is designed to stop that from turning into a system-wide panic. But here's the trade-off regulators won't say plainly. By forcing banks to hold more high-quality capital, they're quietly sacrificing economic growth to protect the financial system. According to BIS modeling and analysis cited by Reuters, stricter capital rules reduce lending growth by several percentage points over time. That doesn't show up overnight. It shows up as fewer job openings, slower wage growth, and tighter credit for small businesses. For the average American family, this hits from multiple angles at once. Credit cards get repriced higher. Home equity lines dry up. Small businesses, which employ nearly half of the U.S. workforce, face tougher loan terms or outright rejection. The National Federation of Independent Business already reports that over 30% of small firms say credit conditions are worsening. Basel III makes that trend permanent. There's another reason the timing matters. Inflation isn't gone. Core CPI is still running close to 3%, well above the Fed's target, while shelter and insurance costs continue climbing. Regulators know the Federal Reserve can't easily cut rates without reigniting inflation. That traps policymakers. They can't stimulate, so they regulate instead, tightening the system quietly rather than triggering panic with rate hikes. This is why the endgame rules were finalized now, not during a boom. The BIS is effectively saying we don't trust the system to absorb another shock without stricter rules. When the referees change the rules mid-game, it's usually because they see something dangerous forming off the ball. Next, we need to talk about what this means for jobs, wages, and household stability. Because the biggest impact of Basel III Endgame won't show up on bank balance sheets. It will show up in everyday life. When banking rules tighten, the damage doesn't show up with a headline saying, Basel III Endgame hits families. It shows up months later in layoffs, frozen hiring, and wages that stop keeping up with prices. That's the real transmission mechanism, and it's already starting. Banks are the fuel system of the economy. When regulators force them to hold more capital, banks protect themselves by pulling back from the riskiest borrowers first. That usually means small businesses, startups, contractors, and households without pristine credit. According to Federal Reserve Senior Loan Officer opinion surveys, lending standards for commercial and industrial loans are already at levels last seen during the 2008 financial crisis. Basel III Endgame makes those tight standards structural, not temporary. Look at employment data. While the headline unemployment rate still sits near 4%, that number hides stress. Full-time employment has been flat for months, while part-time work has surged. The Bureau of Labor Statistics shows that nearly 5.7 million Americans are now working part-time for economic reasons, up more than 800,000 from a year earlier. That's not a healthy labor market, it's a fragile one. Now connect that to credit. Many households bridged inflation over the past 2 years with borrowing. Credit card interest rates are now averaging over 21%, the highest ever recorded. Delinquency rates on cards and auto loans are climbing fastest among lower and middle-income borrowers. When banks face higher capital charges, they don't lower rates to help consumers, they raise them to compensate for risk. This is where Basel III becomes a silent wage cut. Even if your paycheck goes up 3% this year, your borrowing costs, insurance premiums, rent, and food expenses are rising faster. According to BLS data, real average hourly earnings have barely grown over the past year once inflation is accounted for. Tighter credit makes it harder to smooth those costs, trapping families in a cycle of revolving debt. And there's another layer. Many regional and community banks, the ones that finance local businesses and real estate, are disproportionately affected by stricter capital rules. Reuters and the Wall Street Journal have both reported that smaller banks are already shrinking loan books to stay compliant. When those banks pull back, entire communities feel it through stalled developments, fewer jobs, and declining tax bases. This isn't a sudden crash story. It's a slow squeeze. Basel III Endgame doesn't break the economy. It pressurizes it, gradually and deliberately. Regulators are choosing stability over growth, even if that means households absorb the cost through slower wage growth and fewer opportunities. Why markets aren't ready for what comes next? Markets are acting calm, but that calm is misleading. Basel III Endgame changes incentives in ways that don't show up immediately in stock prices, until suddenly they do. The biggest risk isn't a crash tomorrow, it's a mispricing of risk that unravels once liquidity tightens further. Start with equities. For over a decade, markets have relied on cheap leverage, constant buybacks, and easy credit. But higher bank capital requirements make leverage more expensive and less available. According to Bloomberg data, U.S. corporate debt is still above $13 trillion, and a massive portion of that needs refinancing over the next 3 years at much higher rates. As banks pull back, companies face higher interest costs, fewer refinancing options, and pressure to cut expenses, usually labor first. Housing is even more exposed. Mortgage rates hovering near 7% have already crushed affordability, pushing monthly payments on a median-priced home to record levels. Basel III makes mortgage lending more capital-intensive for banks, especially for loans that don't fit pristine underwriting boxes. That means fewer approvals, higher down payments, and tighter standards, even if the Fed eventually cuts rates. Housing doesn't crash because prices fall first. It stalls because buyers disappear. Then there's commercial real estate, the slow-moving problem no one wants to touch. Office vacancy rates in major U.S. cities remain above 18%, according to brokerage data cited by the Wall Street Journal. Regional banks hold a disproportionate share of those loans. Basel III forces banks to be more conservative with assets that can suffer large losses, and commercial real estate fits that definition perfectly. Refinancing risk is growing, not shrinking. Even so-called safe assets aren't immune. Treasury bonds are still treated favorably under regulations, but the sheer volume of government debt issuance is pressuring yields higher. If banks are required to hold more capital overall, their capacity to absorb new Treasury issuance shrinks at the margin. That puts upward pressure on yields, which feeds directly into mortgage rates, auto loans, and corporate borrowing costs. This creates a feedback loop. Tighter bank rules lead to higher borrowing costs, which slow growth, which increases default risk, which forces banks to tighten further. Basel III Endgame is designed to protect banks from collapse, but it doesn't protect the economy from stagnation. And here's the uncomfortable truth. Markets are still priced as if liquidity will return quickly. But regulators are telling you, through these rules, that liquidity is going to stay scarce. When rules and narratives disagree, the rules always win. What Washington and the Fed do next. This is where the story turns uncomfortable. Basel III Endgame backs policymakers into a corner, and history shows they rarely choose the option that helps households in the long run. On one side, you have slowing growth, tightening credit, and rising financial stress. On the other, inflation that refuses to fall back to the 2% target. The Federal Reserve knows that aggressive rate cuts would reignite inflation, especially with government spending still running hot. At the same time, holding rates higher for longer deepens the credit squeeze that Basel III is already amplifying. So what's the most likely outcome? Financial repression, not relief. We're already seeing early signs. Treasury Secretary statements and Fed commentary, covered by Reuters and the Financial Times, increasingly emphasize financial stability over growth. That usually means policies designed to keep the system functioning, even if households suffer. Think targeted liquidity facilities for banks, quiet regulatory forbearance, and subtle pressure on institutions to keep buying government debt. For families, this doesn't show up as a bailout check. It shows up as stubbornly high prices and limited opportunities. Inflation may cool on paper, but essential costs don't fall. According to BLS data, food-at-home prices are still up more than 25% since 2020, insurance costs are rising at double-digit rates, and rents remain elevated even as new leases slow. Meanwhile, wage growth is decelerating. Average hourly earnings growth has slowed to around 4%, while household debt servicing costs are rising faster. The gap between income and expenses doesn't collapse all at once. It widens slowly, month by month. This is why policymakers leaned on regulation instead of rate hikes. Basel III Endgame is a way to de-risk banks without admitting the system is fragile. It shifts the burden away from financial institutions and onto the real economy, where fewer people understand what's happening or why. And there's a political dimension too. Major fiscal reforms are unlikely in an election-driven environment. That leaves technocratic tools, rules, capital requirements, and regulatory changes as the default response. They're quiet, complex, and mostly invisible to voters. What Basel III Endgame really signals about the next phase of the economy and what the average American family should realistically expect over the next few years. When you strip away the technical language, Basel III Endgame sends a very clear message. The people closest to the system no longer trust it to run hot without breaking. Regulators don't demand more capital, tighter ratios, and lower leverage because they expect smooth growth. They do it because they expect stress. For the average American family, the next phase isn't about a dramatic collapse. It's about endurance. Credit will be harder to access, not impossible. Jobs will still exist, but bargaining power will weaken. Asset prices may not crash, but they'll feel heavier, slower, and less forgiving. This is the kind of environment where mistakes cost more and recoveries take longer. Look at the numbers already in motion. Household debt service as a percentage of disposable income is climbing back toward pre-2008 levels. Savings rates have fallen near 3%, well below the long-term average. According to the Fed's own data, nearly 40% of Americans would struggle to cover a $400 emergency expense without borrowing or selling something. Basel III doesn't cause these realities, it locks them into place. The uncomfortable truth is that the financial system is being stabilized above the household level. Banks are being fortified, while families are being asked indirectly to absorb volatility through higher costs and fewer safety nets. That's the trade regulators are making. What happens next is predictable, even if the timing isn't. Slower growth increases political pressure. Political pressure leads to more spending. More spending complicates inflation. Inflation limits rate cuts. And tighter regulation ensures that whatever stress emerges is felt most acutely outside the financial sector. This is not a conspiracy, and it's not a sudden reset. It's a managed slowdown, a controlled tightening designed to prevent collapse, even if it means years of stagnation. Basel III Endgame isn't about tomorrow's market open. It's about the next decade. If there's one takeaway, it's this. When regulators quietly rewrite the rules of banking, they're telling you the old assumptions no longer hold. Cheap credit, easy refinancing, and constant growth are not coming back the way they were. Planning for stability, liquidity, and resilience isn't pessimism anymore. It's realism. The rules have changed. Most people won't hear about it, but they'll feel it in their paychecks, their bills, and the choices they're forced to make.